Price, politics, and risk. You know, these first things are way more connected than you might think. Today, we're going to unpack 3 stories that prove it. We'll look at a huge move by Netflix, a nail-biter of an election, and then a warning about a $2 trillion market that you might not have even heard of. So, all of our analysis this week comes straight from the brilliant folks over at Augusta Global Insights. And let me tell you, they flagged 3 stories that are kind of flying under the radar, but could really shake things up in the markets. All right, here's what's on deck. We're going to start with a household name, then jump over to a really high-stakes international election, and wrap up with a look at a booming part of the financial world that might have some serious cracks starting to show. Let's get right to it. Okay, first up, Netflix. They just made a big announcement about a 10-for-1 stock split. Now, that sounds massive, right? But what does it actually mean for the company and for you, the investor? So, what even is a stock split? Well, honestly, it's mostly a cosmetic change. The company just takes its existing shares and, carves them up into smaller, more numerous pieces. The price for each individual share goes down, sure, but the total value of the company doesn't change one bit.
I love this analogy. Think about it like this. Before the split, maybe you had one big Netflix share worth about $1,100. After the split, you've got 10 smaller shares, each worth $110. You still have the same total amount of Netflix. It's just been sliced into more manageable pieces.
But here is the thing. The real story isn't about the price. It's about the valuation. To figure out if Netflix is actually expensive, we have to look past that shiny new price tag and dig into the company's fundamentals. And, well, these are the numbers that really matter. And this number right here, this gets us to the absolute heart of the issue. Netflix is trading at 36 times its annual cash flow, its EBITDA. For a company this big, that's a very high number. Let me put that 36x into perspective for you. It means that at the rate Netflix is generating cash right now, it would take the company a full 36 years just to earn back what the market says it's worth today. 36 years. That is a long, long time to wait for a return. And of course, this brings us back to some timeless wisdom from the man himself, Warren Buffett. The stock split, it lowered the price, but it did absolutely nothing to change the underlying value. So the real question isn't whether $110 is cheap. It's whether the business itself is truly worth $464 billion. Okay, so we just talked about a single company's valuation. Now let's zoom way out and look at how global politics can completely reshape an entire country's value in the eyes of investors. There's a huge election happening in Chile right now, and believe me, the outcome could send massive ripples across the globe. So why should you care? Well, because the market is already placing its bets, and it's placing them in a big way. Just look at this. BlackRock's Chile-focused ETF is already up a staggering 48% this year. And that's mostly because investors are anticipating a very pro-business, market-friendly election result. The first round of the election was fascinating. Now, on the surface, the left-wing candidate, Jeanette Jara, won the most votes with 27%. But that's not the real story. The real story is that when you combine all the right-wing candidates, they captured almost 3/4 of the total vote. So this all sets up a dramatic 2-person runoff. And now that all those other conservative candidates are rallying behind the main right-wing candidate, Jose Antonio Cost, his odds of winning have just soared. And you better believe the market is paying very close attention. So here's the crucial point, the why it matters. Investors are looking right next door at what just happened in Argentina. When the pro-market President Milei was elected there, it was like the floodgates opened for investment from giants like JP Morgan and BlackRock. The thinking is that a win for Cost in Chile could set off a very similar investment boom. All right, for our final story, let's turn our focus to a risk that might be hiding in plain sight. We're talking about the booming, but kind of murky world of private credit. So what exactly is this market? You've probably heard the term thrown around, but it has just quietly exploded since the 2008 financial crisis. And frankly, a lot of people are starting to get nervous about what might be lurking just beneath the surface. In simple terms, it's basically non-bank lending. See, after 2008, all these new, stricter regulations made it harder for big banks to make certain kinds of loans. So private investment firms stepped in to fill that gap, and in the process, created this massive, nearly $2 trillion industry. But you know how it goes. With high returns, you often get high risk. And this whole sector is really defined by its lack of transparency and very minimal regulatory oversight. That creates a perfect storm where problems could spread really, really fast if things start to go south. For years and years, this market had really smooth sailing, in a world of super low interest rates. But the weather has definitely changed. According to Augusta Global Insights, the storm clouds are gathering, and the conditions are now perfect to expose some of the hidden weaknesses in the system. And that brings us to this case study, Blue Owl Capital, a huge player in this space. They tried to merge two of their funds, but the market hated the idea. And then came the real red flag. They froze investor redemptions. That means people could not get their money out. The stock tanked, the deal was called off. It was a massive warning shot for the entire industry. So the takeaway here is a pretty clear warning for investors. What happened at Blue Owl suggests that some of the big assumptions we've all been making about how stable this booming but opaque market really is, well, they may need to be seriously reconsidered. Whew. Okay, so we've looked at company valuation, global politics, and some pretty serious hidden risk. Let's try to connect all these threads and just quickly recap the three crucial insights from today's analysis. First, and this is so important, always look past the sticker price. Focus on the valuation. That's where the real story is. Second, keep a really close eye on key political events around the world. They can be incredibly powerful catalysts for the market. And third, just be aware of the dangers that could be lurking in these fast-growing, lightly regulated sectors, like private credit. And that leaves us with one final thought to chew on. And today's complex, interconnected market, maybe the most significant threats aren't the ones making headlines every single day. Maybe they're the ones that we aren't watching closely enough. Thanks so much for joining us.